Alright, what's going on, guys? This is the fair value gap and inverse fair value gap 101 tutorial. This is made for beginners, so I'm going to go over all the basics if you guys do not know what a fair value gap is. The first thing I'm going to explain, I'm going to get right into it. I hope you guys do not mind. So the first thing, what is a fair value gap? A fair value gap is an imbalance in price in the markets. So think of a bullish fair value gap being the market is going up and the price jumps, right? Or a bearish fair value gap, the market is going down and the price jumps down. It's an imbalance of price because it either jumps up or jumps down. Now, when you think of a fair value gap, in different terms, think of it as you're walking downstairs and you skip a step to get downstairs faster. That's basically what a bearish fair value gap is, right? Bearish just means the market is going down. Bullish means the market is going up. So a bull market or a bullish market would mean the market's going up. A bear market or a bearish market would mean the market's going down. So a bearish fair value gap would be, let's say you're going downstairs, you skip a step to get downstairs faster. Or you're going upstairs for a bullish fair gap. A bullish fair value gap is when you're going upstairs and you skip a step going upstairs to get upstairs faster. Now, to teach you guys about fair value gaps, you need to know the anatomy of a candlestick. So this is our candlestick. This is a bullish candlestick, a candlestick that is going up. Now, with a bullish candlestick, you have four main things. The very bottom, this is the wick, right? This is a wick, this is a wick, this is the body, okay? Now, the very bottom of the bottom wick is the lowest price that happens in that candlestick. So let's say it's a 1 minute candlestick. In that 1 minute that candlestick is forming, the bottom right here of the wick is the lowest price. This right here, the very bottom of the body, is the open. This is where price opens in this candlestick. The top of the body up here is where price closes in this candlestick. Now, this top part of this wick is the highest point that price goes during this candlestick, during the forming of this candlestick. That is a bullish candlestick. Now over here, this is a bearish candlestick. Same thing, a bearish candlestick just means the candlestick is going down, so the open is at the very top of the body. This is where price opens, and it closes, because it's going down, at the bottom of the body. Now, the very bottom of this wick right here is the lowest price that candle is at during the forming of this candle, and right up here, the top of the wick is the highest price that candle gets to during the forming of this candle. So that is the anatomy of a candle. Feel free to pause it, take a screenshot if you need to. Now that we're done with the anatomy of a candle, we can get into fair value gaps. Right here, remember, bullish, market going up, bearish, market going down. So with let's start with a bearish fair value gap. So this is a downward candle, right? A bearish fair value gap is formed with a 3 candlestick structure. That's why you see 3 candlesticks. The first candlestick, and then you have the wick, and then the second candlestick, and then the third candlestick. You have the top wick. Focus on the gap that this candle is making, right? The gap, I marked it in this green line to this green line. This is the gap, right? You're going downstairs, you skip a step to get downstairs faster. That is a bearish fair value gap. Why did I mark it from here to here? Because it's from the bottom of this wick, the first candle, to the top of the third candle wick. This gap, okay? Now, if the wicks were up here, the gap would be bigger. If the wicks were lower and closer together, the gap would be smaller. But if the wicks were overlapping, kind of like this, well, that's green. But if the wicks, just pretend it was red. I'll change it so you can see it better. If the wicks overlap like that, there is no gap. See? There can't be a gap. So that is not a fair value gap. The wicks cannot overlap. The wicks have to look like this. It has to form a gap. So this would be a bearish fair value gap. Now over here, we have our bullish fair value gap example, right? Market's going up, it's bullish. So we have our first green candle, our second green candle, and our third green candle. Where's the gap? This is a question for you guys. Can you answer that? The gap is right here, right? From here to here. Okay? Let's make it green. That is the gap. Remember, first candlestick, take it from the top wick to the third candlestick's bottom wick. You're going upstairs, you skip a step to get upstairs faster. That is what a bullish fair value gap is. This right here is the imbalance in price, and it forms a gap. All right, and just to make sure you guys understand, this area is the gap. Perfect. Whoops. All right, so that is what a bearish fair value gap is, and that is what a bullish fair value gap is. Now let's continue to the third thing I'm going to teach you, inverse fair value gaps. What is an inverse fair value gap? An inverse fair value gap is when a fair value gap is inversed by a candle close in the opposite direction. And an inverse fair value gap signals a reversal in price. Normally when an inverse fair value gap happens, it signals that price may continue in the direction of that inverse fair value gap. So let's start with a bullish inverse fair value gap. So remember, 3 candlestick structure. We have a down candle. You get the jump in price, forming a bearish fair value gap. So let me draw the bearish fair value gap for you guys. Jeez. That should be red. All right. That is the bearish fair value gap, right? Because first candlestick, bottom of the wick, to the third candlestick, top of the wick. That is the fair value gap. And now an inverse fair value gap is simply when a candle of the opposite color, so this green candle, inverses this bearish fair value gap. It's a bullish fair value gap, or it's a bullish inverse fair value gap because the candle that is inversing this gap is green, which makes it bullish. So this inverse fair value gap is signaling a reversal in price. So it should continue in this direction and continue going up because it's bullish. Now, this candle close, remember, in a bullish candle, the closure is at the top of the body. This candle closure has to be above the fair value gap. So if the candle closes down here, that's not an inverse fair value gap because it doesn't close above the fair value gap. Closed up here, it is an inverse fair value gap. So price should continue going up. Now, this over here is a bearish inverse fair value gap. Can you tell why? Because remember, 3 candlestick structure, you have the bullish fair value gap right here, forms a gap right between these wicks. Jump in price, that is the gap. Put it in green. And then a candle of the opposite color comes down and completely inverses this gap with a red candle, meaning it's bearish. So this is a bearish inverse fair value gap. Remember, this candle close at the bottom of the body closes beneath this fair value gap. If it closed up here, it is not an inverse fair value gap. Perfect. So I hope you guys understand that. Feel free to take a screenshot if you need to. Bullish inverse fair value gap and bearish inverse fair value gap. Bearish fair value gap and bullish fair value gap. Now, you guys know that. Let's hop into a real chart example. So let's get onto the actual charts. Now, obviously, you can see I have an indicator for fair value gaps. Let's get rid of that. My indicator, I'll show you guys my indicator real quick. It's this. It's fair value gap / inverse fair value gap by Nephew Sam. This is what it does. It pretty much marks out all the fair value gaps that have not gone away. So, for example, let's dive into this one right here. Just look at my cursor. This is what I'm looking at. So remember, 3 candlestick structure. First candlestick right here, second candlestick right here, and third candlestick right here. Take it from the top wick of the first candlestick to the bottom wick of the third candlestick in the 3 candlestick structure. Between that is the fair value gap. Ready? First step, skip the next step, keep going up. It's basically just an imbalance in price. This is a fair value gap. This is a perfect example. And then there's one right here, right? Let me draw it out. This is my fair value gap rectangle that I use. This is also a fair value gap as well. So hopefully you guys can understand that. That is a fair value gap. Now let's jump into another example up here. Also, my candlesticks are a little bit different. Mine are not green. My white candlesticks are bullish candles going up. My black candlesticks are bearish candles going down. I just have a different chart color scheme. Now, with my rectangle, I'm going to mark out this fair value gap. Remember, 3 candlestick structure. First one, second one, third one. This is the top wick of the first one to the bottom wick of the third one. Sorry, to the bottom wick of the third one, right there. That's the fair value gap right here. Bullish because it's going up, right? This is the bullish fair value gap. Now, what happens after? A bearish candle comes and inverses, right? It breaks this fair value gap and closes underneath this fair value gap. That is an inverse fair value gap. So you guys see both examples right here on the real charts. We are in micro NASDAQ, right? Fair value gap going up, bullish fair value gap to a bearish inverse fair value gap. Now let's see if I can find you guys an example of a bearish fair value gap into a bullish inverse fair value gap. Perfect, right here. So we have a bearish, right? First candlestick, take the bottom of the wick, jump the second candlestick to the top of that wick. That is a bearish fair value gap, right? Bearish fair value gap right here. Then we have a bullish candle. Completely, obviously, this candle must have been from news or something. It's massive, but you have a massive candle going up, obviously closing way above this fair value gap. So that still is an inverse fair value gap. Now, the reason this is not an inverse fair value gap is because it's a wick, right? It's not a body closure. You need a body closure to be an inverse fair value gap. This is just a wick. You need the body to close above this fair value gap to be a bullish fair value gap. See? This one right here, the body closed, and this is a bearish inverse fair value gap. If it was just a wick all the way up here, it would not be an inverse fair value gap. You need a body closure. But yeah, guys, that is the lesson for fair value gaps and inverse fair value gaps. I hope you guys enjoyed. Stay tuned. Obviously, do not use just fair value gaps. Let's say you see a bullish fair value gap and you buy, or you see a bearish fair value gap and you sell. Or same thing goes with an inverse. Do not use these confluences by themselves. Do not use this concept by itself. It's not made for that. It's just made that you know this so you can pair it with other concepts and form a strategy to actually become profitable. If you just use this alone, you will not be profitable, trust me. But stay tuned because I will be releasing more concepts. I'll be releasing all of my ICT concepts that I use to form a profitable strategy, and I'll also share both of my strategies with you guys in the coming weeks. So stay tuned for that, and yeah, have a great day.